Today is part 2 of our year-end retirement and tax strategy planning series. I'm going to talk about more strategies that you should consider before the end of this year to help put yourself in the best position possible to help reduce your taxes, avoid unnecessary IRS penalties, and build long-term wealth.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of The Retirement Show, all about your life, your money, and your taxes. I'm your host, Scott Searens, and my goal is to help you thrive in wealth and retirement. Now, living in Illinois, it's that time of the year again. Over the last few weeks, that's right, I've had to start prepping for winter. Putting away the patio furniture, getting the furnace ready, changing the furnace filter. At some point in time, I'm going to have to start cutting the flowers back. And I'll tell you what, having a nice, thick green yard is so important to me. So a few of the tasks, not necessarily just for this year, but actually to start prepping for future years, is I had the lawn aerated and I overseeded the lawn, and then right before winter, I'm going to put that winterizer fertilizer on and have that way next year going forward, going to have a nice green, lush lawn. So why do I bring this up? Well, these are all tasks that I have to do not only to prepare the house and myself and my yard for this year, but also to put everything in the best position possible going forward, looking forward to next year and building that green, thick lawn. And so I bring this up because today is part 2 of our 2-part series of year-end planning and financial strategies, tax and financial strategies, what you can do and what you can focus on to help put yourself in the best position possible before the end of this year and also going forward. So that's why I bring it up. Just like we have to prep our houses, prep our lawns, do things around our house to get it ready for the winter and for the following years. What are you doing in your own financial life? What are you doing in your tax life to help put yourself in the best position possible? Now, why are we talking about this in October? You might be thinking, well, it's not the end of the year yet. A lot of these strategies, a lot of these actions that we're going to talk about have a December 31st deadline. And a lot of the financial institutions, if you wait until December to start thinking about it, they've already created another deadline in advance of December 31st to get things in. And so a lot of times if you wait till December, you might be too late. In some of the strategies, the institutions where you might be keeping your money will say, you can submit it, we'll get to it if we have time. And a lot of that's just because they are inundated with requests at the end of the year. Another reason why we tackle things in October, take a look at things in October, is because at this point in time, you're going to have a really good handle on what your income is going to look like for the year. So from a tax projection standpoint, we should be able to create a really good tax projection of where you're going to fall for the year, what your taxable income would look like, what your projected taxes would look like, and where you'll fall in different tax brackets. And that'll also help out with some of the different strategies that we're looking at. Why it's important. It helps you put yourself in the best position possible from a tax standpoint for this year, and then helps you reduce your long-term tax burden for future years. Strategies that we talk about can help you increase your overall wealth, and one of the things that I think is truly important is knowing what changes that you'll have to make and take starting with January 1st, 2023, rather than waiting till January to understand and know what those changes might be. As I had mentioned, the second part of a 2-part series. Part 1, if you want to listen to that, go to lifemoneyshow.com. Again, lifemoneyshow.com. Click on episode 74. We talked about maximizing your retirement plans, how to save more into a tax-deferred or tax-free account if one spouse is working and one spouse is not working. Talked about Roth conversions and the overlooked tax-advantaged account called the health savings account. Today we've got a lot of great information for you as well. We're going to talk about required distributions, charitable gifting, tax harvesting, tax withholdings, and family planning. So with that, let's dive in. So the first item I wanted to talk about today was required minimum distributions. Now, in part 1, episode 74, I talked about ways to reduce the tax on your required minimum distributions. However, I didn't just talk about the importance of required minimum distributions and why they fall into year-end planning and tax strategies. Not necessarily a tax strategy here, more just year-end planning. If you are over the age of 72 and you have an IRA or a 401k or a 403b, any sort of tax-deferred account, or maybe you've inherited an IRA or inherited a 401k from someone else, you may be required to take required minimum distributions. Now, everyone's, when it comes to your own IRA and 401k, those start at age 72. There are some unique scenarios where if you're still contributing to your 401k, that you might not be required to take distributions from it yet. But for the most part, those over age 72, if you have one of those types of accounts, you're going to be required to take it. Why it's so important in part of year-end planning is because your required distributions have to be taken before December 31st of 2022. There is the December 31st deadline, and if you fail to take those required distributions, for example, let's just say your required distribution is $30,000, and you fail to take it, the IRS is going to penalize you 50% of the amount you failed to take. That's right, you're going to owe the IRS, in my example, $15,000. And then not only that, they're still going to tax you on the total amount that you should have taken. So they're going to tax you on the total $30,000 that you should have taken. So it's like a double tax/penalty impact. That's why taking your required distributions are so important. I had mentioned beneficiary or inherited IRAs. Depending on when you inherited the IRA, you may or may not have to take required distributions from it. And so for this discussion, as well as all of the different strategies that we're going to talk about today, you most likely have a scenario that is specific and unique to you. And I highly recommend talking with a financial professional and tax professional just to make sure that you're following the rules that you need to for your specific situation. So if you need to take required distributions from your beneficiary IRA, make sure that you're taking those as well. The next item I want to talk about in our year-end planning discussion is doing a withholding review. Have you withheld enough in federal taxes? And here's why. Have you ever received an unfavorable surprise bill in the mail? Have you had a medical thing where there was bills and you thought you got through them all, and then at the end of the day, 2 months later, you get this surprise bill in the mail and you still owe hundreds or thousands of dollars in regards to this medical procedure that you may have went through? And those surprise bills never feel good. So that's why we want to do a federal tax withholding review. As I had mentioned earlier, October is a good time. At this point in time, we've got a really good idea of how much income that you'll have coming in for this year by utilizing that, plus looking at your deductions that that you might have for this year, or standard deductions. Might be able to estimate your dividends and interest and any other items that would fit onto the tax form. Then you can estimate, and this is what we do for our clients as well, is estimate what the 2022 taxes will be. And then you can compare that to what you've already withheld from a federal standpoint. When I say already withheld, either in your company paycheck, you're withholding for federal taxes, or maybe you're someone who is making quarterly payments into the IRS. Or if you're already collecting Social Security, for example, you might be withholding federal taxes from Social Security. So you want to go and look at all of those different sources and see what you've withheld, and then compare that to what you may owe. And do they align? Because the last thing we want is any surprises come next April. And here's a few examples of what can lead to surprises. Maybe you've retired during the year. Maybe you've got a big bonus at some point within the year. Maybe your income changed at some point within the year. For example, I had one client who received a nice size bonus during the year. Well, the size of that bonus actually put them up into another tax bracket. And when we looked, the company did not withhold enough in federal taxes from that bonus. So when we did their tax projection, it actually showed or projected that they did not have enough withheld and they were going to owe thousands of dollars in taxes. Now, luckily, we were able to catch that right away, but could you imagine going to next April, filing your taxes, and then finding out that you've got thousands of dollars that you owe in taxes, and maybe you've already spent part of that new bonus, or you've saved it, or you've done other things with it. So understanding that right away can help avoid those April surprises. Another part of this is maybe you're someone who gets a lot of money back each and every April from the IRS. Well, what that really means, let's say you're getting thousands of dollars back. It could be a couple thousand or 3,000 or 4,000. What that means is that you've kind of just given the IRS a free loan throughout the year. It means that you're actually having too much withheld through your paychecks, or it means that you're giving too much to the IRS through your quarterly payments. So if you're typically getting thousands of dollars back, and I know that feels really good, but in reality what you're doing is you're withholding too much. You're basically putting too much into the IRS withholding bank, and all they're doing is just giving it right back to you at the end of the year. So instead of withholding too much, another thing that you can look at is updating your withholdings for future years to make sure that you're just getting what you're owed when you're owed it. So getting paid as much as you can throughout the year. And then that way, at the end of the year, yes, you're not getting thousands back, but you actually got that money throughout the year, money that was yours versus just putting it in that, I'll call it the make-believe IRS holding bank. So doing a withholding review is a really good task to take place in October. Again, something that your financial professional and tax advisor can help you out with. And then looking at future years to say, okay, if I've been withholding way too much and I'm going to get a lot of money back this year, what do you need to do? What are the updates that you can make so in future years, more of your money is coming to you versus giving that free loan to the IRS? All right, let's talk about some tax reduction strategies. If you're someone who gives to charities, donates to charities, I want to talk about some charitable gifting and planning strategies. Now, in part one, we talked about qualified charitable distributions, the strategy that you can utilize to help reduce the taxes on your required minimum distribution. So if you're over the age of 72, or if you're taking required minimum distributions and you give to charities, go back, listen to part one, again, lifemoneyshow.com, episode 74, to hear all about ways to reduce the taxes on your required minimum distributions. If you're not of that age, or you're not taking required minimum distributions, but do give to charitable organizations, depending on how much you give, there might be some strategies available to you. Now, you probably recognize in 2017, the Tax Cuts and Jobs Act nearly doubled the standard deduction. And so it's become a lot more difficult to get the itemized deductions. You know, a lot of times there's not only just the benefit of giving to a charitable organization, but the IRS has written rules and laws where there's also a potential benefit from a tax standpoint. But when those standard deductions doubled, it made a lot more difficult to get that benefit from the IRS and tax standpoint, to get that tax write-off. Because in this year, if you were a single, the standard deduction was $12,950. And if you're a couple, the standard deduction was $25,900. That means your itemized deductions, charitable contributions, other itemized deductions, would have to, as a couple, surpass $25,900 before you'd be able to write off those charitable contributions. However, there might be another way where you're continuing to provide a benefit to a charitable organization, but also have a way to take that deduction on your taxes. And I mentioned earlier, it all depends on how much you contribute. And this way is what's called a donor-advised fund. I'm just going to give you a general overview of how it works and the overall concept. Again, check with your tax professional and financial professional. But let's just kind of go over a general way of how it works. Let's just say you consistently contribute $10,000 a year to different charitable organizations, and you're a couple. Well, as we had just went over, that $10,000 a year falls under that standard deduction of $25,900. So yes, you're still helping out the charity. However, there's no write-off in that scenario. But what if we pooled together multiple years of those donations? So maybe you've got money sitting in a checking or savings account. Maybe you have a brokerage account where you've got funds sitting in there as well. And if you're consistently contributing this money and you plan to in the future, what you can do is put multiple years into a donor advised fund. So in our example here, let's just follow my example. Let's say you're like, I'm going to continue to do this at least for the next 5 years. Well, we can take 5 years of those donations, $50,000, and you can put them in a donor advised fund. Now, when you do that, you're actually then able to write off or put into your taxes as a tax deduction that $50,000 that you've put now into that donor advised fund. Now be aware, once you put it in the donor advised fund, there's no taking it back. You don't have to donate it or contribute it all in 1 year. You can contribute that money throughout your lifetime, so it can happen over the next 5 years, 10 years, 20 years, however long you decide. But here's then how it helps in reducing your taxes. Since you did multiple years at the same time, where before, if you're just doing all of those single $10,000 a year, you would have never achieved enough to surpass the standard deduction. You would have just gotten the standard deduction. Now that you group 5 years together, put it in the donor advised fund, for that year, you're going to be able to put that $50,000 deduction in your taxes. And then on top of it, in those subsequent years, you're going to get the standard deduction. So it's a way not only to help out a charitable organization, but also to help potentially reduce your overall tax burden. The next item I want to talk about today is tax harvesting. Now, you may have heard of tax loss harvesting, but there's both tax loss harvesting and tax gain harvesting. This might be something that you want to take a look at for your non-retirement accounts, those brokerage accounts, the non-401k, non-IRA, non-Roth IRA. These are your after-tax accounts that you might want to look at this on. And today I'm just going to give you a general overview. There's a lot of rules behind this, and you want to make sure that you follow the rules. Otherwise, this may not work for you, and then you actually end up owing tax or not getting the benefit from doing this strategy. This is a strategy where if you want it to count for this year's taxes, it's something that needs to be completed before December 31st. So let's just say you have one of those accounts, and right now we're looking at a down market, so you might have some positions in those accounts, those taxable or brokerage non-qualified accounts. You might have some positions that are down in value from when you first purchased them. And so what tax loss harvesting is, again from a conceptual level, is selling positions, capturing those losses when you sell the position. So you're going to sell a position for a loss, and then you can use those losses to offset other gains or to offset your income. Now, you can only utilize losses to offset $3,000 of wage income or income. So if you take $10,000 of losses, don't think that you can just use that to offset all of your wage income, or $100,000 of losses, using that to offset all of your wage income this year. They do have very specific rules on that. Now, if you don't let's just say you take $100,000 in losses, and the only thing that you have to apply it against is your income. Well, as I mentioned, you're able to use $97,000. That doesn't mean you're only able to use $3,000. That doesn't mean the other $97,000 goes away. It just carries over to future years. But another way that you can use this, and it may not come into use this year, maybe it will, but if you have positions where you have gains and you're thinking to yourself, oh my, like I've got some great gains in this account because maybe you've had the account for 5 years, 10 years, or longer, and you've been wondering how you can capture those gains but without paying the tax on them. This is a way to do that. You can, if you've got positions that you've sold for losses, then maybe you've got positions that you sell for gains, and those then can offset each other. So maybe you've held a single stock in your account for a very long time. You can use, and you've had some great gains in it, and you've just wondered, well, when do I sell it? I want to start collecting from it, but I'm like, oh, I don't want to pay all the tax and all the gains on that position. Well, if you've had positions that you took the loss on, you can apply them, sell some of the position that you have the gains on, and those can be applied against each other. Again, this is one where you want to talk to your tax professional, your financial professional, because there are rules called, one is the wash sale rule, which if you don't follow the rules, then it could completely ruin using this strategy. So if you've got those non-retirement accounts, hopefully I've just triggered a thought for you to sit down, look at those accounts, talk to somebody about potential not only tax loss harvesting, but tax gain harvesting as well. The last part that I want to talk about in today's episode is what I'll call is family planning. And maybe you could look at it as family tax planning. A few things to think about. Maybe you're in a position where you can help out others, or it's important to you to help out your children or your grandchildren. Or maybe you're in a position where based on what you've saved, you might be looking at estate taxes in your future. And one of the things that the IRS allows is for you to help out others. One of the things that you can do is if you have grandchildren and you want to help them out with their college education, you can help them fund their 529 plans. Another thing that you can do is gifting. And I wanted to talk about this one because this one does have a December 31st. Actually, they all have, again, these both have a December 31st expiration for what you're able to do for each year. And I wanted to kind of go over that gifting example and the reasons why you might want to think about it. One is you just want to help out a family member or a friend, or there's somebody important to you that you want to help out. Another reason is that if you are in a position where you might be looking at federal estate taxes, one of the things that you can do is start getting money and savings out of your estate and transferring it to your children, transferring it to somebody else, so that way that money won't then get hit by those federal estate taxes. Another reason to consider it is maybe you don't plan on using all of your money and you're at a higher tax bracket than where your children currently are. And you're thinking to yourself, okay, I've got this money, I'm at a higher tax bracket, and it's causing you taxes, but if you're not planning to use it and your children in a lower tax bracket, you might want to consider gifting it over to them early. And that's really looking at family tax bracket management. So a lot of different reasons, again, just from helping out to a tax standpoint of where gifting comes in. And each and every year, there's a gifting exclusion, meaning you are able to gift to someone else a certain dollar amount without it applying to your taxes. And in 2022, the annual exclusion for gifts is $16,000. And let me just explain how this works. So let's just say we have husband and wife, Bob and Jane, and they have their son, John. Well, Jane can give John $16,000, and Bob can also gift to John $16,000, And both of those gifts fall within the annual exclusion, meaning nobody has to file anything from an IRS standpoint. Now, this also assumes that you're not taking money out of your IRA or 401k, because any money that comes out of those types of accounts is going to get taxed. But if you have money in a brokerage account, savings account that you're going to be just gifting to somebody else, again, that annual exclusion is $16,000. Now, let's say in our example, John has a daughter named Rebecca. Well, not only could Bob and Jane each give John the $16,000, but they can also each give Rebecca $16,000. And so as you can see, it's per spouse and then per, we'll call it beneficiary. And so just something to think about. There's a lot of different reasons why you may or may not want to consider this, but it is something where the reset clock on it is December 31st. So if it's something where you're looking to transfer wealth out of your estate, then you want to make sure that you're utilizing that exclusion by December 31st so you can utilize it again come next year. All right, I hope that you found today's episode to be of value and benefit. And taxes are always on our mind in helping you reduce your overall tax burden. Going along with today, to help you keep more of your hard-earned money in your pocket versus giving it to the IRS in taxes, we've got a guide on our website that you might find helpful. You can go to lifemoneyshow.com/taxes. Again, that's lifemoneyshow.com/taxes, and it's a guide that provides tax reduction strategies that you can implement in your specific scenario. What it does is it's going to walk you through the different strategies to help you understand if they apply to you or not. And what it means that you're paying the IRS what you only legally have to and not leaving them a tip, helping you increase your overall wealth. I hope that you found both today as well as part 1 in episode 74 helpful. If so, subscribe to the podcast. That way you get notified as we continue to come out with new episodes each and every week to help you continue to build wealth and reduce your long-term tax burden and be financially confident and ready for your retirement. Hey, I look forward to our next conversation to help you enjoy life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.